Hello, everyone, and welcome to the podcast. I am Michelle Moses, your host, and today we are going to be talking about assumable loans. And we have Mike here to talk with us. Thank you for joining us, Mike.
Yeah, absolutely. Thanks for having me. This is awesome.
Yeah, and Mike started a company. How long has it been?
A little over a year.
Okay.
About a year and a half ago, probably, is when we started the company.
Yeah, called UMe, and it is about assumable loans, and that's what they specialize in. And you guys, this is pretty exciting because if you are in or outside of the market and you are wanting to buy a house, but the interest rates are too high for you, this might be a solution for you because you can assume these low rate mortgages. And we are going to go into detail about how you can get these. So let's just start out about what an assumable loan is.
Sure. So what I always like to do when I explain what an assumable loan is first what it's not. And so like, let's say, for example, you're a listing agent, you're a realtor, and it's like those first 8 phone calls you get from just what I call TikTok investors, that they went on TikTok and they saw that, hey, I can get something for $0 down. I just have to assume the responsibility for this loan. And they call you up and they say, hey, I'd love to assume your loan. But they're not actually assuming it. They're doing, remember that subject twos and wraps and where the seller's still on the hook. This is a totally different market. It is government loans that are mandated by law to be assumable. And what that means is a buyer can come in, and as long as you have a qualified buyer and a willing seller, these servicers, which a servicer is just the current seller's mortgage company, they have to do it. So they are mandated by law to allow the assumption if you have a qualified buyer and a willing seller.
And the assumption is that you are actually taking over the loan. You're not just kind of taking over the payments.
Right.
Your name goes on the loan with the mortgage company.
Yes. Key difference between that whole subject to world is the release of liability. Buyer goes onto the loan, seller comes off of the loan. It's now the buyer's loan.
Okay.
So complete release of liability.
Right. And I think the difference is that the house needs to be marketed as this, right? So you need to know that they're going to have an assumable mortgage on it.
I mean, yes, you want to definitely advertise it as an assumable mortgage just because there's value there to that low interest rate loan.
Right. And you've seen, so I've taken some of your classes, obviously. Right. So you've seen people like clamor for these things. Like when a listing agent is listing their house and it's like with this as an assumable loan of 2.5%. I mean, people like clamor over these houses. They are
overwhelmed. The listing agents become overwhelmed sometimes. If they're not super familiar with assumable loans and they, like you said, if it's a 2.5% interest rate with kind of like a low delta, meaning the difference between the sales price and the loan amount, I mean, they're getting offers within hours from like a lot of times investors, because investors seem to be they catch on quickly, they're savvy, and they're aggressive when it comes to like these, like I guess you would say, incredible deals. Yeah,
because they're going to save a ton of money so that they can then rent that house, right, for a lower amount or make more money, really.
Because what really cash flows in this market, the interest rates at 7 and 8, it's just, there's no way to really cash flow.
Yeah, so it's the only way that they can cash flow is getting some of these lower interest rate loans.
Right.
Yeah, okay. And so can we go through kind of explain the difference, because I have sent this to some people and said, okay, look, you could get some of these houses at, such and such price, because on your website, it does say, this price is $1,300 for the payment.
Right.
And I do want to take it a step further, because you do have to come to the table with the difference between what people are selling it for and what the loan amount is, right?
Exactly.
Okay.
So like in the assumption world, it's totally different than the new financing world. You don't think of it as like, oh, VA loans 0 down, FHA loans 3.5% down, conventional or 5, 10, 20, 25% down. That's the new financing world, which is not the assumption world. So assumption down payments, they simply are this: sales price. So let's say, for example, it's $500,000 and the assumable loan amount of $400,000. That means there's that $100,000 gap or delta. So that means it's $100,000 down payment. But let's say, for example, if you're buying it as your primary residence, there's still some conventional financing sources out there for a second mortgage where you can actually, you can finance it. What is it up to? Well, the reason I stutter a little bit is because there's one out there that's
changing every day, but
they are. It's like 5%. There's one out there for 5% down, but I kind of started because I was thinking I didn't know if I wanted to announce that because we haven't completed one with that investor yet.
Okay.
But one that we've completed a lot of is 10% down. So that means if someone
people would need to at least say we're going to come with 10% down, but you might assume the loan for some of the house,
right?
And then for the other part of the house or the other part of the payment, you could get a second mortgage up to 90% of whatever the value of the home is,
like
or whatever you're buying it for.
Like the old days of 80-10-10s, if you remember those.
Right. And then even so, and this is what I think is cool about your website and what you do, is that you run all these illustrations. And so it's like, even though you're going to assume that, and people go, oh, that second mortgage is so high, you know, what are they at 8 or 7 or 8?
11.
Oh my God,
depending
11?
Depending on the loan amount, yeah.
So even though it's at 11,
yeah.
and who knows when you guys are watching this, it might be even different, but at 11%, then even though it's mixed, just because it's such a smaller amount at that 11%,
right,
then it's still a lower payment than getting a regular mortgage at 7.
Yeah. So we call it, like, it's the concept's just blended rate. And really what that is just the old high school weighted average.
Yeah.
So it's, say for example, you have that $400,000 loan at 2.875, and then you have to get that $50,000 second at like 11%. That freaks people out. First of all, they're like, 11%. Oh my gosh, there's no way. But the blended rate on that's probably close to 4%.
Right. And you guys, you also need to think about too that when you're taking over these rates or over these loans, then you have already paid like a ton of interest. Like the seller has already paid all that upfront interest.
Yeah.
And so when you go onto UMe's site and run all these illustrations, it'll show you how much you're paying in interest and how much you're paying towards principal, because you're already like jumping into a loan, paying a bunch of principal depending on the age of the loan. That was the part that I was like, okay,
that's the wow factor.
Yeah, that part is super powerful, because if you really run the numbers and could calculate how much in interest you're probably going to save, I mean, you could pay more for your house because you're going to save so much more in interest. That's what I thought was like just mind blowing.
Yeah, we had that specific example of that one house. It was like a $765,000 original loan amount. And when you compared it, the assumable loan to the conventional loan, you saved, it was like $720,000 in interest over the course of the loan.
Wow. There was a story you told that this guy was saving like $34,000 in interest a year. And so he
That's the one.
Yeah. Oh, is it?
Yeah.
And so he went ahead and paid $34,000 more
50.
for the house. Was it 50?
He spent 50
because
more.
He was like, that's only a year and a half in interest, and I'm going to live there for how long, you know, so who cares?
Well, he looked at that was like, he basically looked at the interest he was saving from a payment perspective, right? So that the payment savings was like $1,800 on that house.
That's crazy.
Per month.
Yeah.
So he's like, this is
that's
no-brainer.
a lifestyle change.
Yeah.
I mean, really, you're $1,500, $2,000 a month in savings. Yeah. Yeah, I think this is going to be huge. I mean, I really think that as this starts to catch on, that the listing agents need to start, you know, like people, if you're going to be listing your house, you really need to check on what kind of loan you have, because you might be able to get more for your house. And then on the other side, if you're buying, you might be able to get into a bigger house or better house or at a better neighborhood or whatever you're looking for than what you were before, right?
That is so true, because there's what happens a lot of times, buyers, their mentality or thought process, they think in one thing first. They say, okay, here's a house, right? Here's my payment if I did new financing, but there's an assumable loan on it, so my payment's going to be smaller, right? So they see that as the advantage. But exactly what you just said, some of them don't think of is, so this is a $500,000 house for a specific payment that they're qualified for. But if they took that same payment and they applied it to a more expensive house and they use that payment, I mean, they're in a whole different neighborhood, a whole different school district that they're able to get into.
Just with an assumable loan.
Yeah.
So the type of assumable loans we're talking about, can explain the types, because not all loans are assumable. So we didn't really go into that yet.
Okay. So basically, assumable loans, all government loans are assumable. So that's FHA, VA, and USDA. And we don't talk much about the USDA thing because the mechanics for assuming those loans are just, they're a little, janky, I guess is the best way to put it. And we don't really see too many of them. So we focus on VA and FHA. They're all assumable.
Okay.
Now, if you go to the conventional side, there's only a couple different types that are reasons why conventional would be assumable. You've got you have conventional arms. So you might have, say, for example, a 7-year arm. But you want to be careful, especially if you're on the listing, if you're a listing agent or you're on the listing side. Because if you call into your mortgage company, because we ran into this. So a client called into the mortgage company, asked if their loan was assumable. And they answered yes. Yes, your loan is assumable. So the agent says, okay, great. We're gonna have an open house, $1.1 million assumable loan, right? 7-year arm. Super excited about it, garnered a lot of interest. Well, what happened was the mortgage company was correct in saying yes, but it wasn't assumable for another 6 years.
Until they got out of that 7-year arm
Until
period.
they're out of the fixed period.
Okay.
Exactly.
All right. And that makes sense.
Yeah. So you want to be careful.
Yeah. Okay. So some are assumable, but you really need to ask your questions, which is why they come to you and make sure that.
To make sure that it is assumable and when.
So would you recommend that agents, if they're going to list the house, or a client, if they wanted to list their house and wanted to know, they would call you first to make sure it was assumable? Because you know all the companies and...
Exactly. So one of the things is the first step is obviously to find out if it's conventional. Hey, is this assumable? There's not many that are, but if you do have a conventional arm, definitely get with us so we can figure that out. But all government loans are assumable. So again, VA, FHA, you already know it's going to be an assumable loan.
Well, and you guys, the VA, and a lot of people don't know, unless you have a VA loan. I think people know when they have a VA loan. But FHA is usually, if you put 3% down, right, you usually have an FHA. Yeah.
There's a good chance of that.
That's kind of a good litmus test for people to remember. Exactly. Okay. And I think on the VA loans, everyone remembers that they have those, but sometimes the hesitation with those is that they don't, the veteran doesn't want to give up. So we should say a VA loan is for veterans, you guys.
Right.
The veteran does not want to give up their loan because they think they won't then be able to go purchase another one. So that is also a rumor, right? That is not, that's not true. So can you explain a little bit about that?
So basically when you look at that's probably the only real confusing piece to all of the assumption industry is a veteran's entitlement and how that works if they allow a non-veteran to assume their house. So the way that works is, so basically VA benefits are broken up into two things, eligibility and entitlement. Eligibility, if you think of it as a credit card, eligibility is yes or no, you're qualified for the credit card. Entitlement is for how much. So let's say, for example, a veteran has an original loan amount of $350,000, right? And they allow someone to encumber their loan, meaning
so
assume it, take it over, and that means their entitlement becomes encumbered, which is just VA's term for tied up.
So they're giving away $350,000 of their credit entitlement,
line. Right?
Yeah, their credit line. Okay.
So they still have some bonus entitlement, so they can go out and purchase another home with VA financing. It's just under a limited amount, and we have calculators for that. And like any of like the people watching can get in touch with you or me to figure out what that looks like. So based on what their plans are for the future.
Even before they list their house.
Right.
Because then sometimes people want to downsize and it doesn't matter if it's encumbered or whatever. Because if you're going to make more on your house, right, you might be able to sell it for more. That might be worth it to have more cash.
Exactly.
So because you're letting your entitlement be used by someone else.
It's just a matter of getting all the information and making an educated decision outside of just oh no, I heard you're not supposed to do that.
Right. Exactly. Right? Yeah. Yeah, it might be a great way to make an extra. Who knows? I mean, that other guy made an extra $50,000 on his house.
Right. We've seen 50, 60,000 just on just based on the loan itself.
Right, because people want to. If they think they're going to be in the house for a long time, then obviously it's a good way. Yeah.
And there's no appraisals on assumptions.
Right.
Oh. So that you don't have to. So listing agents don't have to worry about the appraisal issues. Buyers don't have to worry about it appraising. There's no appraisals unless you get secondary financing. That secondary financing company might require an appraisal, but the assumable loans don't.
Okay. Yeah, and you guys, a lot of these are just all listed on a website. You know, like I should say, if they're in the system in the proper way, if they're in the MLS in the proper way, they are on the UMe website, and you can just go on there and look around at the different areas of town and see if something makes sense. And it even says, the cash that you need to bring to closing. And if you don't have that cash, then obviously you need to work with Mike at UMe and see, what you qualify for.
Right. See what kind of secondary financing you can get. How can you make it happen?
Yeah. I just think credit is so fascinating because there's just so many ways. Like once you get into it and you start to understand it, there's just so many ways to finance different things, and people get really overwhelmed. But I think that you should just kind of get in there and start learning because it's just by osmosis.
Right.
You will start to understand it because some people just talk about with numbers, their mind just goes blank. Right.
Math, right. It's math.
Yeah,
all
like
I heard was
math or anything.
Right.
Or you asked me to log on to my whatever account. But I do think that as you start to learn about some of this stuff, I mean, the ways that you can get into houses or purchase, reconfigure some of the financing is just fascinating to me all the time.
It's been one of the biggest surprises I think in this industry for me is I thought that secondary financing was going to be a huge piece. Like people they have to get secondary financing to get into these homes, but we probably only have secondary financing on 2 to 3%.
Really?
Yeah, it's
so people are coming with cash.
They find the money and. I don't know how they all do it, but they find the money, whether they're taking from retirement or whatever. We've had some people take from retirement. We've had kids buying and then their parents are like, oh, I remember I got an assumable loan back in 88 or something like that. I loved it. I will give you the down payment if you get this, 2.25% interest rate.
Yeah.
And so it's just a whole different ballgame when it comes to finding money for this type of thing.
Yeah. Well, and I think getting into a home is important because I do have some people in retirement that don't own, and it really does encumber your options. And so I realize, you guys, that getting into a home is very expensive right now, and it might seem cost prohibitive, but if you can get a roommate, if you can, buy a tiny little condo and have a roommate, like do whatever you can to just get some equity and to get going, it totally pays off later on down the road.
Oh,
yeah,
for sure.
Because you don't want to be a victim to whatever the rents are when you're 85 years old.
Right.
Yeah.
So we've had a lot of some like older people or anybody that was looking to pay cash for houses, because a lot of people are like, oh, I'm just going to pay cash, right? They've sold the house somewhere.
Right. Get an assumable loan at 2.5%. Why not?
Come in with it. Sometimes you need a big down payment, but instead of paying like cash for everything, talk to your financial advisor. And you're getting debt in the 2s and 3s these days. Those financial advisors will tell you all day long.
Yeah, just take the debt. Yeah.
Take the debt.
Right.
I can make more money with your money.
Yeah. Yeah. If you guys have a low interest mortgage, you really need to check into this assumable thing before you sell your home if you're thinking about listing your home. So yeah, it could bring you a lot of money. Well, thank you, Mike.
Yeah.
Thanks for all this information. I think this is going to be a big thing. So I'm glad we sat down and talked about this.
It is definitely going to be a big thing.
Yeah. All right. Thank you, everybody, for listening. And be sure to leave me a review or let me know if you have other topics that you want to listen to. Thanks.